If your portfolio is all about those sweet, sweet dividends, you might be missing a crucial piece of the puzzle. Let's break it down. Dividend investing is often seen as a straightforward way to generate income, especially for those who are looking for a steady cash flow. But there are nuances and complexities that many investors overlook. Dividend investing with ETFs like SCHD seems like a no-brainer, right? After all, who wouldn't want a simple, diversified investment that pays out regular dividends? Simple, diversified, and those juicy dividends. It sounds like the perfect recipe for a successful investment strategy. However, there are several factors that you need to consider before jumping on the SCHD bandwagon. But here's the kicker, it might not be the smartest move. While the allure of dividends is strong, there are underlying issues that could impact your overall returns and financial goals. First, SCHD isn't as passive as you think. Many investors assume that ETFs are entirely passive, but that's not always the case. Choosing stocks based on dividends is actually an active strategy. This means that the fund managers are making specific choices about which stocks to include, based on their dividend payouts. Over 15 years, 80 to 90% of active funds lag behind passive ones. This statistic is crucial because it highlights the risk of underperformance when engaging in active stock selection. Since 2011, SCHD returned 399%, but the S&P 500 hit 484%. Ouch! This difference in returns can significantly impact your long-term wealth accumulation. SCHD holds around 100 stocks, but the S&P 500, hundreds. The broader diversification of the S&P 500 reduces risk and captures more market opportunities. Only a third of companies pay dividends, and just 4% of stocks drive most market gains. This means that by focusing solely on dividend-paying stocks, you might be missing out on significant growth opportunities. You're missing out on potential big winners. And those dividends? They don't create wealth. Dividends are essentially a redistribution of a company's earnings, not an additional source of income. If a $100 stock pays a $5 dividend, its price drops to $95. This price adjustment reflects the payout, meaning you haven't gained any extra value. You've got $95 in stock and $5 in cash, no extra money. This is a critical point that many dividend investors overlook. Lastly, dividend growth isn't magic. While it can be appealing to see your dividend payments increase over time, this growth often comes at a cost. Companies paying dividends might skip growth opportunities. By returning cash to shareholders, these companies may be foregoing investments in new projects, research, and development that could drive future growth. It's better to invest in companies increasing their intrinsic value. Companies that reinvest their earnings into growth opportunities can potentially offer higher returns over the long term. So why do some stick with dividends? It's the psychological comfort, the steady cash flow, and personal preference. For many investors, the predictability of dividend payments provides a sense of security and stability. In the end, broader market ETFs offer better diversification and higher returns. By spreading your investments across a wider array of stocks, you can reduce risk and capture more growth opportunities. But if dividends keep you calm and committed, they might be right for you. The key is to understand your own financial goals and risk tolerance. They might be right for you. Remember, investing is a personal journey, and what works for one person might not work for another. Choose wisely and invest in your unique journey. Make sure to do your research, understand the pros and cons, and align your investments with your long-term financial goals.